Are you sitting on an interest rate on your current home of maybe 4, 3%, or even 2%? And I bet when you got that loan, you thought, boy, I'll never touch that loan. And guess what? For the majority of Americans, they never had. No one wants to refinance those. Instead, you do a home equity line of credit if you need cash. But then what if the following happens? You have to relocate, you outgrow the house, or you become an empty nester and you need to downsize the house. You want to move to a new location that you discover that you really like. There's about 10 reasons that people move. And what happens is that need to move, the need or the desire starts to outweigh it. But then that mortgage low rate will hold you back and think, well, I'm going to wait for rates to fall. Well, people have been waiting for rates to fall for 5 years or close to 5 years now. And the thing about it is I do expect interest rates to fall, not to the threes or fours, not to the threes or twos, maybe into the mid fours at some point. But as rates fall, it spurs demand and increases price growth. So I want to share with you something. If you've been really involved in what's called the mortgage lockdown effect, and that's where you feel locked into your house because of your current interest rate. Let me show you what's going to happen to prices over the next 5 years. All right, so this is Fannie Mae's forecast, 2025, 2026, 2027, 2028, and 2029. You can see anywhere from 3.5% all the way to 4%. Here's the thing. In the last 2 years, they were predicting like 3% growth. It hit 6 in 2023. It hit 5 or almost 6. It was close to 6 in 2024, and we're at 5% year to date with the current prices. So let me show you what that looks like for a house price. So this is the key slide. This is just using a $400,000 house. So just based on the appreciation, the Fannie Mae forecast. So let's call it roughly an average of 3.75. You're looking at a $400,000 house you buy today. If you waited 5 years, you have to pay $479, and you can see it stair step up. And the likelihood is that we will actually have higher inflation than that. Higher appreciation than that, of closer to 5%, maybe even 6%. So that's the key. Here's why that's the key. What you don't realize is that you're thinking, well, I've got this low interest rate, and if interest rates come down, I'll be able to buy that house and it'll be more affordable. The reality of it is that when you buy that house 5 years from now and pay, $479 versus $400, it doesn't matter what the interest rates are going to be because your payment's going to be higher. When you're looking at a payment of mortgage, there's actually 4 main components of it. And as a homeowner, you know this. If you're a first-time home buyer watching this, this will be helpful as well. Basically, you got your principal and interest. Well, that's controlled by and that's your actual mortgage note, right? The principal and interest. That's controlled by not only the interest rate, because usually there's a 30-year fix, it's amortized, there's a simple formula for that. So it's controlled by the interest rate, but it's also controlled and largely driven by the size of the loan. So the higher purchase price you go, the higher base loan amount you're going to have, regardless of what your current cash input would be to that, right? So that's one of the big drivers. The other big driver is insurance. And insurance has gone way up. It's starting to come down a little bit. Hopefully that'll come down in the future. And then the third one is really property taxes. Property taxes have been going up based on valuation. So if you look at 479, then you're looking at not only a higher amount financed, but you're looking at a higher property tax rate to set your homestead cap on. And those are the two killers. The fourth one I mentioned is mortgage insurance premium, which some of you will have that, some of you won't, depending on your down payment. But the two big ones are directly impacted by price. So keep that in mind. If you're sitting right now and you have a 3-4% mortgage, a 2% mortgage, and you're thinking about, you're at a point where like there's a location I really, really like, it might be time to make the move. Let go of the interest rate. What's more important is, does the payment cash flow for your debt ratio? In other words, is your payment going to be an acceptable amount for your debt ratio? Those are the kind of things I do for my clients. I'm a certified mortgage planner. I will actually help you as part of your loan approval process. We start by building a mortgage plan in which we look at things like how to structure the loan to most effectively get you to point A to point B, grab that equity and move on. And one last thing, keep in mind, you might have that low interest rate, but you also have a ton of equity, and that will really mitigate your opportunity to grab that equity and move out. So thanks so much, and I hope you have a wonderful day.